In 2017, two investors started with the exact same amount of money, $100,000. One of them spent every weekend researching stocks, chasing hot sectors, timing market corrections, and constantly rebalancing a complicated portfolio filled with international funds, gold, energy stocks, emerging markets, and speculative tech companies. The other investor did something almost painfully simple. They bought a single ETF, ignored the headlines, closed the app, and got on with life. Fast forward to 2026, and the second investor quietly outperformed the first by a massive margin. No stress, no endless research, no emotional panic selling, just one boring fund, compounding in the background, while the rest of the world obsessed over market noise. That story perfectly captures one of the biggest truths in investing. Wealth is rarely built through complexity. It's built through consistency, patience, and owning the right assets for the right stage of life. The problem is most people are using the wrong investment strategy for their age. A 22-year-old is investing like someone about to retire. A 55-year-old is gambling on aggressive growth stocks like they still have 40 years left. And because of that mismatch, millions of people are destroying their own compounding without realizing it. So today, we're going to fix that. If you could only own one ETF for each decade of your life, what should it be? Which single fund gives you the best balance of growth, stability, income, and long-term survival depending on your age? Using real historical data up to 2026, this is a complete age-by-age ETF framework designed to maximize wealth while reducing unnecessary risk. Your 20s are unlike any other decade in investing because you possess the most powerful financial advantage in existence: time. At 22 years old, you can survive market crashes that would terrify older investors because you still have decades ahead of you. A temporary 30% drop means almost nothing when your investment horizon stretches another 40 years into the future. That changes everything. In your 20s, income doesn't matter. Stability doesn't matter nearly as much. What matters is maximum long-term compounding. That's why the best single ETF for this stage is SCHG. The Schwab US Large Cap Growth ETF, SCHG, is built around the most dominant growth companies in America. Businesses aggressively reinvesting profits back into expansion instead of paying massive dividends. Companies like Nvidia, Apple, Microsoft, Amazon, and Broadcom aren't focused on sending investors cash today. They're focused on becoming even larger tomorrow. And that's exactly what young investors should want. SCHG has historically delivered explosive, long-term performance because it concentrates on innovation, technology, artificial intelligence, cloud computing, semiconductors, and digital infrastructure, the sectors driving the modern economy forward. From 2017 through 2026, SCHG averaged close to 19% annualized returns. That level of compounding is life-changing. A single $100,000 investment left in touch grew toward nearly $500,000. Most people underestimate what that kind of growth really means. The difference between earning 10% and 19% annually over decades isn't small. It's the difference between retiring comfortably and becoming financially free decades earlier. Yes, SCHG experiences painful volatility. There will be brutal years where it drops 20%, 25%, or even 30%. But in your 20s, volatility is not the enemy. Emotional reactions are the enemy. Young investors destroy their future wealth by panicking during corrections instead of understanding that market crashes are simply the price of admission for long-term outperformance. Your 30s are where life begins shifting from pure accumulation to responsibility. Careers become more serious. Families enter the picture. Mortgages, children, businesses, and financial obligations suddenly make extreme volatility feel far more dangerous than it did at 23. At this stage, you still need strong growth, but you also need durability. That's why the best single ETF for your 30s becomes VU, Vanguard's S&P 500 ETF. VU represents ownership in 500 of the largest and strongest companies in the United States. Instead of focusing heavily on aggressive growth stocks alone, VOO spreads risk across the backbone of the American economy. You still own giants like Apple, Microsoft, Nvidia, Amazon, and Meta, but now they're balanced alongside healthcare companies, banks, industrials, consumer businesses, and energy corporations. This diversification matters because it smooths out the violent swings that pure growth funds can experience. Historically, VU has produced roughly 15% annualized returns over the past decade while maintaining far lower volatility than aggressive growth ETFs. That balance is incredibly powerful in your 30s, because this is often the decade where investors emotionally break during bear markets. Someone with children and financial obligations reacts differently to a market crashed than a 22-year-old living with roommates. VOO helps reduce that psychological pressure while still generating exceptional long-term returns. Another advantage is simplicity. VOO carries an expense ratio of only 0.03%, meaning almost none of your gains disappear to management fees. Over time, low costs matter enormously because every percentage point lost to fees is money no longer compounding for your future. Warren Buffett himself repeatedly recommended low-cost S&P 500 index funds because they quietly outperform the majority of actively managed portfolios over long periods of time. It isn't exciting, but wealth rarely is. When you reach your 40s, another important shift begins. By now, your investment portfolio is hopefully becoming substantial. You may be approaching your peak earning years. Retirement no longer feels infinitely far away. At this stage, concentration risk becomes more dangerous because your nest egg is large enough that a major collapse in one sector could seriously impact your future. That's why the ideal ETF for your 40s becomes VTI. Vanguard's Total Stock Market ETF, VTI, essentially represents the entire American stock market in one single investment. Instead of only owning the 500 largest corporations, you now own over 3,500 companies across large cap, mid cap, and small cap stocks. This broader diversification creates a more resilient portfolio because economic leadership changes over time. The biggest companies today may not dominate forever. Throughout history, leadership rotates between sectors and company sizes. Sometimes technology leads, other times industrials, small businesses, or value stocks outperform for years. VTI automatically captures all of those rotations without requiring you to predict the future. That matters enormously because most investors fail when they try to forecast which sector will dominate next. VTI removes the need for constant decision-making. It accepts a simple reality. The U.S. economy will continue evolving, and owning the entire market ensures you benefit regardless of which companies eventually lead. Historically, VTI has slightly trailed the S&P 500 in raw performance, averaging around 14% to 15% annually. But the trade-off is significantly broader protection. In your 40s, protecting accumulated wealth becomes just as important as aggressively growing it. That subtle transition is what separates mature investors from reckless ones. Your 50s are psychologically dangerous because this is where fear begins taking control of many investors. Retirement suddenly feels close enough to touch, and people start obsessing over protecting what they've built. Unfortunately, that fear often leads to terrible decisions. Many investors panic and abandon growth entirely, piling into high-yield dividend traps, bonds, or cash far too early. The problem is simple. If you retire at 65, your money may still need to last another 30 years. That means your portfolio still needs growth. This is why the ideal ETF for your 50s becomes VIG, Vanguard Dividend Appreciation ETF. Notice something important here. VIG does not chase the highest dividend yields. Instead, it focuses on companies with a long history of consistently increasing their dividends year after year. That distinction matters tremendously. High dividend yields often signal struggling companies with weak growth prospects, but dividend growth companies tend to be financially disciplined, stable, and highly profitable businesses, capable of surviving recessions, while still rewarding shareholders. VIG holds elite corporations like Microsoft, Visa, Broadcom, and PepsiCo, companies with strong balance sheets and consistent cash flow generation. Historically, VIG has produced lower volatility than the broader market while still delivering excellent long-term returns around 12% annually. More importantly, its downside protection has been exceptional during economic downturns. That matters emotionally because large losses become harder to recover from as retirement approaches. A 25-year-old can wait decades for recovery. A 58-year-old may not have that luxury. VIG creates a middle ground between growth and stability, allowing investors to remain exposed to equities without experiencing the full emotional brutality of aggressive market swings. Your 60s mark the transition from accumulation to distribution. The game fundamentally changes here. Your goal is no longer maximizing portfolio size at all costs. Your goal becomes generating reliable income while protecting yourself from catastrophic drawdowns. This is where SCHD, Schwab US Dividend Equity ETF, becomes incredibly powerful. SCHD focuses on high-quality dividend-paying companies with strong balance sheets, sustainable cash flow, and histories of consistent payouts. Businesses like Coca-Cola, Chevron, Texas Instruments, and PepsiCo dominate the portfolio because they generate enormous amounts of stable cash, regardless of economic conditions. The biggest difference here is income. SCHD currently delivers a dividend yield around 3% to 4%, meaning a $1 million portfolio can realistically generate over $30,000 annually in passive income alone. That changes the emotional experience of retirement. Instead of constantly selling shares to fund living expenses during market downturns, retirees can rely more heavily on dividend cash flow. That reduces sequence of returns risk. One of the biggest threats retirees face. Sequence risk occurs when a major market crash hits early in retirement, while you're simultaneously withdrawing money. Selling assets at depressed prices permanently damages long-term sustainability. SCHD helps reduce that risk by creating a more stable income stream independent of stock price fluctuations. Historically, SCHD has also shown remarkably strong downside protection compared to the broader market. In retirement, stability matters more than chasing maximum growth. Protecting the longevity of your money becomes the priority. By your 70s, the focus shifts almost entirely toward dependable monthly cash flow and minimizing volatility. At this stage, surviving financially matters more than outperforming the market. That's why JEPI, Morgan Equity Premium Income ETF, becomes one of the most compelling choices available. JEPI operates differently from traditional index funds because it combines defensive large cap stocks with covered call option strategies designed to generate high monthly income. This allows the fund to produce yields often ranging between 8% and 12%, far higher than traditional dividend ETFs. For retirees, this can create meaningful monthly income without constantly selling shares. On a retirement portfolio of roughly $400,000 to $500,000, JEPI can potentially generate several $1,000s per month in distributions. That kind of predictable cash flow can dramatically reduce financial stress later in life. Of course, nothing comes free. JEPI sacrifices some upside during strong bull markets because covered call strategies cap part of the gains. But for someone in their 70s, prioritizing stability and income over aggressive growth, that trade-off may be completely reasonable. The psychological value of consistency becomes enormous at this stage. Retirement isn't just a math equation. It's emotional. The ability to sleep peacefully during market turbulence matters. And that's something younger investors often underestimate until they experience it themselves. The biggest lesson across all these decades is that investing is not static. The correct portfolio at 25 is not the correct portfolio at 65. Your relationship with risk changes because your relationship with time changes. Younger investors can recover from volatility. Older investors must prioritize sustainability. But the deeper truth is this: the best investment strategy is usually far simpler than people think. Most investors fail not because they pick terrible funds, but because they constantly interrupt compounding. They chase trends. They panic during crashes. They switch strategies every few years, searching for certainty that doesn't exist. Meanwhile, the investors quietly building real wealth are often doing something incredibly boring. They buy strong low-cost ETFs, stay invested for decades, ignore the noise, and let time do the heavy lifting. That simplicity feels almost disappointing in a world obsessed with complexity, but history keeps proving the same lesson over and over again. The market rewards patience far more than intelligence, and the sooner you understand that, the sooner your money starts working harder than you do.